Good morning, everyone. Welcome to today's quick start training. My name is Greg. I handle training here at Academy Day Trading, making sure everyone is up to speed on the same page. They can get started with Pro9Trader as soon as possible. Try to develop some good trading habits with these indicators, learn how to anticipate the trade setups so we can get in ahead of time. And also we'll just cover uh, the indicators a little more in depth and how we can use those to spot the best trades possible and get in as early as possible. So that's our goal with that. Of course, we want to answer any questions you have. So if anyone does have questions, feel free to holler at me in the questions box. And real quick, let me just make sure my mic's working. If you guys could type a 1 in the questions box, if you can hear the sound of my voice. All right, Jennifer, Matthew, thank you. Excellent. Scott, Greg, glad to see you guys in the room. Welcome. All right. So if you guys have any questions, of course, go ahead and type them on in there, and I'll get to them as soon as possible. If I'm in the middle of a trade, or we're discussing a trade or the money management, wait till I'm done to get to it. So don't worry if I don't get to it right away. And if you're referencing a specific trade setup, maybe one that I'm not looking at, so also include the market and time in Eastern time so I can reference that quickly. All right, so let's go ahead and jump right into it. So I've started doing it this way the last couple of weeks where I just want to put the charts up real close to market open rather than review them myself so we can walk through bar by bar. I feel that it gives a better simulation of how you would see these indicators develop and how we can use that to spot these trades rather than just kind of jumping back and just picking out good trades. While it does have value, I feel this just does the job a bit better. So I got NQ up. I haven't really looked at these charts this morning, been kind of busy, but let's hop right into it. So we have our opening bell right here. Well, this is 2 minutes before opening bell. And I do like to look at the charts before market open just to get an idea of what's going on right now, if there's going to be any possible trades right at the opening bell. Some of the markets do tend to move right at 9:30 or 9:30:03 or something like that, a few seconds after. So we can assess the situation and determine if I could possibly have an order in ahead of time for a trade setup that might take off right at the opening bell. So in this case, it doesn't really look like we have much going on. We see a couple of our EMAs aren't really in order. The 50s and the 20 look like they're right on top of each other. We are trending short. It looks like these EMAs may get in the correct order. Our blue line is on the correct side of the histogram for a short trade, and our super trend is outside of its neutral zone. So this lets us know basically that we have a few of our rules qualified. Many of our trades share rules, so it can just give you a good idea of what to look out for. Because we want to be prepared. We don't want to try to catch the trade that's already leaving, or imagine a train leaving the station. We don't want to be the ones chasing after it, trying to hop on the caboose. We want to be able to spot it ahead of time. But at this point, not much going on, right? And after this next bar plots, we see that our EMAs are now in the correct order for a short trade, either a short continuation if we get a couple of turn bars in a row, or a possible momentum short, since the momentum has the least, well, didn't mean to do that. A momentum has the least amount of rules to qualify a trade, so it's very simple, especially with these new updated indicators. Some things to look for that make it a lot easier, especially if you're brand new, is our colored EMA background. As with the recent update, this tells us if the 10, 20, and 50 EMA are in the correct order, and also that our blue line is on the correct side of the histogram. And for a short trade, we want it below the pink line. So right now, after this bar plots, and it's not even opening bell yet, it's right before, so it's likely we may not get in or have to attempt a retracement or something like that. But at this point, we know we can keep our eyes peeled for a momentum. And all we need after this point for momentum is a momentum arrow. Now, of course, it's a little bit easier because I can see this ahead of time, but during the forming of this bar, as soon as this wick pops up here, you'll see this momentum arrow. So you will know that it's a possible momentum entry before the bar closes. And that's exactly what we want, because we want to know we have our EMAs in the correct order, which is rule 1. We have our blue line below the histogram, which is rule 2. And then we have our arrow, which is rule 3. So once all of these 3 rules are qualified, we would enter using the DPI that creates this bar, the red DPI. Since we're heading short, we want to use the red DPI. And we'll take a look at the DPI in a minute. So as soon as this arrow pops up, I know that I can put in my red DPI of 5024.75. And then once that DPI is reached, it will close this bar, and if everything goes according to plan, fill my order and get me in that trade. And our momentum trade has a 15-tick stop and a 6-tick profit target. And our money management strategy is similar, regardless of the initial stop and target if it's different. The momentum trade and breakout trade are the only two that use a different stop and target. But the main principle that we're about to go over remains the same for all of our money management. So we're going to enter a trade using 3 contracts, and we want to use a stop limit order, and that'll let us place our order in ahead of time, only getting filled when it reaches a certain price. Once it is filled, we have our 3 contracts, an initial stop of 15 ticks, and a profit target of 6 ticks for 2 of our contracts. The 3rd contract is not going to have a profit target, since that's going to be our runner. After this first bar plots, we're going to be 4 ticks toward our profit target. And I know that because it takes 4 ticks moving in the direction of the trend to plot a new color bar. And before the second color bar closes, we'll have reached our target profit of 6 ticks. So we would sell 2 of our contracts to extract our initial profit from the market. And our 3rd contract will be adjusted to break even, or our entry price. There's occasionally some confusion where some people think it means break even for the whole trade, but we don't want to give our runner an opportunity to take any of the profit we just got from these first 2 contracts. And it's also in here at no additional risk beyond this point. We can't lose money on it. And it's just here to take part in as much of the run as possible. Now with the momentums, several things can happen. If the trend is strong and the price is just consistently moving down, you'll often adjust your stop to break even, and then it'll continue to move, and eventually we can widen it. Since we hit our profit target in the middle of the bar, you may sell your first two contracts, adjust the stop on the runner to break even, and then the price will wiggle back up and stop you out. That's going to happen sometimes, but that's okay because we've already hit a profit target. We already got 12 ticks out of the trade. And I'm happy with 12 ticks as or compared to none. So we'll walk through the rest of this money management strategy and how we would manage these runners. We're going to leave the stop at break even until we get to the fourth bar from our entry bar. At that point, we can start trailing at the high of the previous bar since we're trending short. If you're in a long trade, you would start trailing at the low of the previous bar. And as the next bar plots, which in this case is the turn bar, so we would get stopped out right here on at the high of this bar, which the runner would net a tick at that point. But so we hit our 6-tick profit target. We got a tick on the runner, not bad, but we can still be prepared for what happens next. So I have this upward turn bar, and now I can look for a continuation short. I have 3 of my EMAs in the correct order still, the 10, 20, and 50. We don't need to worry about the 200 for a continuation setup, but the setups are stronger when all 4 EMAs are in the correct order. My blue line is not on the correct side of the histogram, but it is very close. I'm very happy with it being in here. It looks like it's just going to cut across, and then it's going to jump right back out if this next bar is a turn bar, which is what we want it to be because that'll qualify our continuation. And our single T is pretty far outside of its neutral zone. So we have basically 2 out of 4 rules qualified at this point. But I would still feel confident about entering a continuation because I know at what price a turn bar will be plotted. It'll be our red DPI. So I could put in a stop limit order at this point, 50/20.75. Right? So I put in my stop limit order for my 3 contracts at 50/20.75. And then if that price is hit, I'm expecting, well, if that price is hit, I know this next bar will be a turn bar, which will qualify my rule number 4. And if this plots as a turn bar, I'm extremely confident, due to how close this blue line is to the purple line, that it will definitely cross back out and get to the correct side of the histogram. And at the same time, it will fill my order. So you don't necessarily need to have all the rules qualified before we put an order in, because we can anticipate what will happen if a certain price is reached, our entry price. And that's a very good habit, and I think something that a lot of people who are just starting out with the system miss is of course you want to double check and be careful and make sure you're fully qualifying the trade correctly. But we can also use these, and I think it's a great habit to get in, of how to not necessarily predict what's going to happen, but we can have a really good idea of what's going to happen when a certain price is reached. And this is due to the DPI. I see Joe had a question about a particular trade in the YM. So we'll use this to discuss the DPI, and we'll go over that trade in a second, Joe. All right, so this is our DPI indicator. It's a very powerful indicator. It's our dynamic price index, and this tells us at which price the next bar will be created. And what type of bar it will be if either price is reached. Since we're trending long, if it hits this upper DPI number, which is usually green, it's yellow for a reason, we'll cover that, then we'll plot a new color bar. If it reverses and hits the red DPI, it will plot a turn bar. And then if it continues to trend short and continues hitting the red DPI number, it will continue to plot red bars. That was a momentum entry there, or it would actually be a continuation entry, but it looks like we were very close to the 200. And these DPIs will turn yellow to warn you that you are going to run into the 200 before hitting your profit target if you enter that trade. So since we can know there's only one of two outcomes here with our DPI, it's either going to create another color bar or a turn bar. So we can anticipate what will happen if the trade moves in the direction we're hoping. And the great thing about that also is, say we put an order, for some reason we're looking to get in a short trade here. If we put in our order at 19,768, and the price just continues to move up to the green DPI, we're never going to be filled since we're using a stop limit order. So we can cancel our order and just wait for the next qualified trade setup. That's why it's very important to use stop limit orders. So we don't want to put in market orders where it'll just get us in the middle of the bar. We want to use the DPI prices as our entry for a few reasons. The one I just covered, how we can anticipate ahead of time. It lets us know our entry price at a glance. And it also lets us put our entry at a price where we can wait for the market to prove to us that it's going to move in our direction. Now, of course, it won't always continue to move if we hit our DPI, and that's something to be prepared for. But it is still very powerful for the market to confirm that it's going to be moving in your direction. And Jennifer mentions it was yellow to warn you that you were close to the 200 EMA. Yes, so as a general rule, as we can see in our rule here for a continuation, down here at our bullet point, the 200 EMA is not used, but there must be enough distance to reach the first profit target of 8 ticks before hitting an EMA. So we don't want to run into the EMAs, most specifically the 200, as it can be a very strong point of support and resistance. And the DPIs will now warn you when you're within that range and you don't have enough space. So generally for a trade like the continuation, we need our profit target plus a tick. Irv is asking about stops. We'll go over that in a minute as we go over some more trade setups. And let me get back to Joe's question, the YM continuation at 1253. He was asking about this one that was developing. So this would, you would be able to enter this on, no, we wouldn't be able to enter this one for the reason of the 200 is we're not really confident that we're going to move through the 200. As we just saw, the price came up, bounced right off the 200, came back up. In this case, it did move through, but we don't know that that's going to happen. We could easily just as bounce off again. I have seen the 200 be a really strong point of resistance, and you just never know when the price is going to break through. So we err on the side of caution, as it's much safer just to not enter that trade and wait till we're clear of the 200 and we have another trade set up. So otherwise, the rules are qualified, but that is something universal we want to watch out for. We never want to enter a trade that's heading into the 200 if we don't have enough room to hit our profit target. Let me get back to the NQ so we can go over this trade. So since we went over our DPI, right here I put in my order, and since this is a continuation, we're going to enter 3 contracts again at 50.20.75. With our continuation, single T, dot trend, divergence reversal, they all follow the same money management strategy. It is 3 contracts, our initial stop of 22 ticks, a profit target of 8 ticks, and that'll be for the first 2 contracts, and our third contract will be again the runner. So we do see that this did plot as a turn bar, so this would plot, and this is a very edge case situation. So this would have been a case where I would have entered a trade, and after that bar plots, it would be an unqualified trade situation. If we see here that our blue line did not quite make it, and this does happen very rarely. Typically, when you're within this range, it does move out quite enough, but there might have been a lot of price action up here that just prevented this blue line from hopping out all the way. So I do want to stress this happens very rarely. Typically, it will hop out, and this is an edge case, but we'll roll with it. I entered into an unqualified trade. We'll see how it develops. Now, if we were being more cautious and we didn't enter on this turn bar, we could also enter on the first color bar as well. And we want to follow the same money management strategy. But after the first color bar plots, we're halfway to our profit target. All right, sorry about that. So after our first color bar plots, we're halfway to our profit target. And at this point, we want to adjust our stop from 22 to 18 ticks. We're going to move it up 4 ticks since the trade moved 4 ticks in our favor. And then after the next color bar plots, we have hit our profit target. We would sell 2 of our contracts for the 8 ticks each and adjust the stop on a runner again to break even. And we would leave it at break even until the close of bar 5, where we would start trailing at the high of this bar. And these yellow or gold numbers will tell you the high and low of the previous or most recently completed bar. After the next bar plots, we'll just adjust our stop to the high of this bar. And now once bar 7 plots, we have the option to widen our stop from the high of the bar to the green DPI. So in this case, that would be 50.20.25. Now we are widening our stop a bit, but this does have its advantages. The main one is to ride over any wicks that will appear on this run that could stop us out. Now, as an option, you can also just continue to trail at the high of the previous bar. If we get stopped out by a wick, it's likely to trigger another momentum entry. It's very rare that it doesn't. But I think overall, real quick, let me hop in here. Let me finish this trade, this money management, and we'll get into your question, Jennifer. So widening to the DPI will let us ride over any wicks. Because since we're using the opposite DPI, we know that when that price is reached, it's going to create a turn bar. So it has to travel 22 ticks to hit that price and stop us out. Now the next bar could be a turn bar, and we give up a little of the quote unquote secured profit we had with that runner. But the way I look at it is it's not my money yet because I'm still in the trade, and I want to try to maximize the profit from this trade. And I think a good way to do that is widening to the DPI. And it also makes the trade simpler to manage, I think, as each new bar plots, we'll just adjust the stop to the DPI. But in this case, we did get stopped out. So it's going to happen sometimes. We would have had a few more ticks if we kept the stop at the high of the previous bar. So, and in the long run, I don't know that there's a huge difference between the P&L if you just continue to trail at the high of the previous bar rather than widening to the DPI. And it really just depends on your style of trading and your personal goals throughout the day. And let's get to Jennifer's questions. All these adjusting stops, you're not actually going in and changing every time, but set it up with rules, right? Yes, you can set up an ATM, and we do have that on the website with instructions to do that, where it will manage the trade for you once it gets filled. So you'll still have to manually put the order in, but it will manage it from that point, and you can set it to adjust your stops. Let's actually bring up our website here. A few things I do want to go over real quick. I didn't cover news first. Very important. I usually cover this first thing. Is market news. We are very concerned with market news, specifically any news events that have a red, black, or green dot next to them. We will not enter into a new trade 5 minutes before or 5 minutes after that news event. We've seen a higher frequency of qualified trades that go against us during these news windows. So it's best to just sit on our hands during this time and wait for that news to pass. So this morning we did have 9:45 news. So we would not be trading from 9:40 to 9:50. The gas report we're not really concerned with because we don't trade the natural gas. And as far as the ATMs, Jennifer, you can go under Resources, Essential Tips, and ATM Settings to automate your trade management. And this will walk you through, there's a couple of videos that will walk you through how to set these up in the NinjaTrader Dome. We can see there. There you go. So there's one for our regular trade setups, like the continuation single T with the 8-tick profit target and 22-tick stop. And then one for the momentum trade, which is 6-tick profit target, 15-tick stop. And then the different trailing options that approximate either trailing at the high or low of the previous bar or widening to the DPI, since it can't be programmed to do both or execute the trailing stop exactly as described in our money management strategy. So we've just given a few options as approximations, something for you to try out. You're of course welcome to adjust those if you find something that works better for you. So those are more just guidelines to start with. But the first half of the trade, where after you enter, where it adjusts to 18 ticks after moving 4 ticks in your direction and selling your contracts off and adjusting the stop on the run to break even, all that is managed exactly as described. It's just the trailing stop that's a bit different. All right, so let's get back to our NQ examples. So we did get stopped out with our trailing stop, still managed to grab a couple ticks. And now I'm looking for another continuation. So my blue line is a bit high, and after this questionable entry, or this blue line, I may be a little more cautious and just wait. As well as I have a really bloated super trend. I don't have a red dot, so I'm not too concerned with a reversal. So if we're going to be a bit more cautious, we're going to wait to confirm that the blue line will cross. So we're going to wait for this bar to plot to see what happens. After this, I decided, you know what, that was a little risky of me. This wasn't technically qualified on the turn bar. Even though it was very close, and 97% of the time it would hop out, in this case it didn't. So I'm going to wait for this next turn bar or this next bar to plot to see if it's a turn bar. It is not. So, and in this case, even if we had put in our red DPI, it wouldn't have been reached, so we could just cancel our order and wait for the next setup. So there is still a possibility of a continuation, but I would definitely need to wait for that bar to plot to see the blue line get on the correct side of the histogram again. In this case, we did hit our turn bar, but as we can see, the blue line did not quite get there, but we can still enter up to the first color bar. And so then it reversed again. It seems like we might be heading into some chop, as our blue line is not heading to extremes. We have a couple turn bars in a row. Ideally, I'd like to see a few more, so it's not clear signs of chop, but the market may be reversing. And we have another turn bar now. And now, at the close of this first color bar, we can attempt for a retracement. Since we had to wait for this bar to close to confirm our entry, we'd want the price to come back up above our original entry price and then hop in the trade. As it is fully qualified now as a continuation, we do have our red background letting us know that our EMAs are in the correct order. The blue line did make it to the correct side of the histogram. Our super trend is very far outside of its neutral zone, and we just had our turn bar. And again, we'd managed it the same way. And something I didn't mention about this trade earlier, but we can see here, we are heading into the low of the day. And some of you may have noticed that and be a little concerned about that. We do have a rule for that, which is another of our bullet points. And this can be considered universal as well. Just like the 200 can act as a point of support and resistance, so can the high and low of the day. So generally, we want to have enough room to hit our profit target before running into the low of the day, as there is a risk of bouncing off, unless our direction histogram is outside of its neutral zone. So here we can see it is clearly outside of its neutral range, which is this gold area in here. So when this is outside of its neutral zone, that also tells us that if this wasn't qualified as any other trade, it would be qualified as a breakout if the price moves through. So it gives us that extra confidence that we're going to push through the low of the day and at least hit a profit target. Of course, it's not a guarantee, as nothing in trading is, but we have seen the odds of the trade succeeding go up when this direction histogram is outside of its neutral zone. And again, this is a continuation, so we'll enter at the same time, or the same way, with our 3 contracts, 22 tick stop, and our initial 8 tick profit target. Halfway to our profit target, adjust our stop from 22 ticks to 18 ticks, and then we've hit our profit target. So we've secured 16 total ticks. Joe mentions, real quick, don't want to just hop out in the middle, but Joe mentions a continuation setting up. This would actually be or momentum setting up on the YM. Yes, this is a qualified momentum, as we do have, we can see our 3 EMAs in the correct order. Our entry price is past the 200, and our blue line is on the correct side of the histogram. So that is a qualified momentum trade. Well, I guess we can talk about this a bit more and how we can use our DPI. So at this point, and we can see how much time we have to qualify this trade, right? And I already know this will be my entry price if I decide to enter into this trade. And it's really that simple. It took maybe 10, 15 seconds to qualify that. It makes it very easy with the colored background. And it's really, 3 rules. We can see EMAs in the correct order, blue line above the purple line, momentum arrow. And that's all we need. Besides being cautious of the 200 or high or low of the day, which we are clear of those, so we don't have to worry. So it is a qualified trade. All right, let's finish this continuation setup, and then we'll search for some of the other setups. Hopefully we can look at a divergence reversal or a dot trend trade today. I want to see if this will be a good example of widening to the DPI and how that can benefit long runs. So we've sold our 2 contracts for our 8-tick profit target and adjusted the stop on a runner to break even, which is where we are now. We're going to leave the stop on a runner at break even and unfortunately get stopped out here by this turn bar. So we did manage to get into a couple trades and at least hit our profit target, which is one of the great things about this money management strategy. Even if our runner doesn't go, we did extract our initial profit and give ourselves the opportunity to catch a runner, which I think is very important because we're never going to catch one if we don't leave that 3rd contract in. And it was no risk. We got stopped out at break even. So no loss there. And now it looks like the price is going to reverse a little bit. We did have a single T set up here. So this will be a good time to go over the differences between the continuation and single T. As you may have noticed, they are very similar in their rules, except the single T by default requires all 4 of our EMAs to be in the correct order. So in this case, we need the 10 below the 20, below the 50, below the 200, which these are all in the correct order. We need our turn bar, which is rule 4, our super trend outside of the neutral zone, and our blue line on the correct side of the histogram. And again, we can see that our blue line isn't there just yet, and it will often be the blue line that you're waiting for confirmation from. Now, the major differences between a continuation is a continuation will always appear in this configuration with a turn bar followed by another turn bar, or a turn bar, color bar, turn bar. As the reversal's so short that it can be thought of as a continuation of the previous run. And a single T will have multiple color bars in between the turn bars, indicating this is a fresh turn bar or single turn bar trade. Now we would have to wait for this bar to close to hit our to confirm that our blue line did get to the correct side of the histogram. And this follows the same money management strategy as the continuation. So again, our 3 contracts, 8-tick profit target, 22-tick stop. halfway to our profit target, adjust our stop from 22 ticks to 18 ticks, and then sell 2 of our contracts at our profit target and adjust the stop on our runner to break even. And after this one, we'll go searching for some trades so we can cover some of the others, hopefully see a breakout. All right, so in this case, this wick would stop us out, but we have an opportunity to get in on another momentum entry. We are right on the low of the day. It looks like this bar actually breaks through. And so this is a case where entry price is going to be 1 tick better than if we entered on this as a breakout. Either one is really acceptable. The only difference, they both have the same 15 tick stop. A breakout will have an 8 tick profit target. So I would like this as a momentum since the entry is 1 tick better. And we have had some resistance breaking through the low of the day up to this point. So we're halfway to our profit target. If we're looking for a 6 ticks, or more than halfway, we need 2 more ticks. We did catch this little wick here, but our stop is still at 15 ticks. So either, without looking at a second chart to confirm, either we hit our profit target and then came up, so our runner would have been stopped out, or this wick came up first and we continued down. Either way, we could hit profit target, get stopped out, and enter into another momentum trade. And then we can see this one start to run. So let's walk through, because I really want to show this example of widening to the DPI and how that can benefit us in these long runs. So we're going to start here on this momentum entry. We'll say we hit our profit target with this one, got stopped out by this wick on our runner, and now we're entering back in at 5,008.75. And again, we're looking for our 6 tick profit target with a 15 tick stop. More than halfway to our profit target, we'll leave our stop at 15 ticks. I don't see much of a benefit to tightening it, as sometimes we can get these double wicks where it'll come up very close to 15, and I feel that tightening it to 11 actually might lead to more stop outs in the long run. So, and then we'll hit our profit target somewhere in the middle of this bar, sell our 2 contracts, adjust the stop on our runner to break even. And again, on the 4th bar from our entry bar, we're going to start trailing at the high of the previous bar. Then we'll adjust our stop to the high of this bar after it plots. And at this point, we can widen our stop to the green DPI, as that'll actually be below our original breakout, or our break-even stop. And once we widen to the green DPI, as each bar plots, we're just going to adjust it to the new DPI that's displayed. So we're basically going to be adjusting it up 4 ticks after every bar plots. And we continue to do that, and now we have a pretty high wick here, but we're going to be able to ride over it because we know that the only thing that's going to stop us out is a turn bar. So we ride right over that one, keep adjusting our stop, and then eventually we get stopped out here. But we were able to take part in a good portion of this run. So, and this is a good contrast, and one of the things I don't really like about trailing at the high of the previous bar the entire way, while it can secure more ticks initially, you'll run into these situations where we got stopped out by this wick here. And this one would have hit profit target. It did go 2 bars. Um, but you may end up in a situation where the wick is here and you might get stopped out before hitting our profit target. So to me, I just think it's much simpler, less stress. Once I get to the point where I can widen to the DPI, to start trailing that way. I may run into these situations where I widen to the DPI and get stopped out right afterwards, and I have a few ticks less than I would have, but that's okay because I don't want to cry over money that wasn't necessarily mine, you know. I think it helps the psychological aspect of trading, not to get, not to let your mind run away with that greed of, a couple ticks, because in the long run, I think following this will let us take part in longer runs and avoid any risky situations with these momentum trades that appear toward the end of a run. Because, as I'm sure, if any of us could predict the end of the run, we'd be doing pretty hot. So, unfortunately, not something that can really be determined ahead of time. So I think widening to the DPI avoids that situation altogether and still lets you, take part in 13 bars of this run, which is pretty good. I'd be definitely happy with a 13-bar run this early in the morning. Not quite a divergence reversal. Seen that. Let's take a look at a couple of our other markets to see if we have any divergence reversals or some of other trades we could take a look at. Couple long runs here in the EMD. This will be a good example. I would like to point this out. See here we have three to four little legs. This would almost be one, as we just have a short little run up and another continuation. Once you see these runs, usually 3 legs or 3 waves of a run, and then it tends to run out of steam. So as you can see here, we had one nice short run, a little small one with another continuation. So this is very edge, could be 1.5. And then we have this other long run. And after this point, it does become a bit more risky to enter into continuations if another one pops up. As we've just seen, and I'm sure if you guys go back and check, or you may have noticed this as well, but once you have a few good legs of a trend, it does tend to become less likely that a qualified trade will hit profit target. So, and we do see that here, as this one would have been stopped out, as well as this one. So we kind of ran out of steam after this run. So something I just want you guys to be aware of. Joe mentions possible dot trend long CL. Awesome. Thank you, Joe, for keeping an eye on these markets for me. I do appreciate that. All right, let's see. Possible dot trend. I do not have a dot on mine. So this one would have been a dot trend. Let's check our EMAs. Yeah, this one would have been very close. For the dot trend, it is a bit of an oddball compared to our other trades. Not those rules. And it will often appear in this configuration. But the dot trend is when we're not looking for the 10 to be in the correct order. So you'll often see the 10 in between these other EMAs. And it's when these, you can see there's a short downtrend here. The EMAs kind of get pinched together, and then they're going to spring out. So our rules for the dot trend, of course, our first clue is going to be our green dot. And the dot will just appear somewhere in the middle of the run. It's simply a price swing indicator letting us know there is a possible price swing on the horizon. So in this, we're not concerned with the super trend. We're not concerned with the 10 EMA. So we need our green dot. We need our 20 above the 50 above the 200, which these EMAs are very close. It's possible they are. When we check the data box, we only see 2 decimal places, but there are more that are calculated that are just not displayed. So it's possible, but I would just like to show this as an example because the dot trend is probably the least common trade, appearing maybe 3 to 5 times a month in a given market. So it is a very strong setup, however. So whenever I do see one, I will hop on that opportunity. And something also I would like to point out, and one of the reasons why this may be a little trickier initially, is since we're not looking for the 10 EMA to be in the correct order, this trade will almost always appear when we don't have a background color confirmed. So, and I think that's an area where when we see a black background, our EMAs aren't in any kind of order to look for a trade. When that happens, I think we're kind of conditioned to just not really pay as close attention. But this is one of those trades we might miss if we kind of tune out when that happens. So something to be aware of is there are trade setups that don't require all of the EMAs to be in the correct order. And again, our blue line isn't on the correct side just yet, so we will have to wait for the first color bar to plot to confirm. And in this case, it does just cross. So we could enter a retracement on the first color bar entry price, and it's likely that the next color bar will dip below that. And this trade follows the same money management strategy as the continuation and single T. We enter 3 contracts with our 8-tick profit target and initial 22-tick stop, adjusting the stop to 18 ticks after the trade gets halfway to its profit target. And then once we hit our profit target, of course, we'll continue to trail the runner until we get stopped out. So I don't want any very brand new traders to get intimidated by the dot trend or divergence reversal if we come upon one. If you're very new to Pro9Trader, we do recommend just focus on the single T and continuation at first. They're very similar in the rules they look for. They're a good foundation to build upon since the rules are pretty straightforward, and just focusing on those trades, you can get in the habit of pre-qualifying trade setups as they appear and get in the habit of what to look for as far as the rules are concerned with some of the simpler set of rules, and eventually then you just start noticing other things and all the rules kind of fall into place. And after you're comfortable with the single T and continuation, you may want to tack on the momentum trade, as it's very simple, easy to qualify, follows same sets of rules. So all 3 of those are very good foundational trades that really give you a good starting place. And then you can throw in the breakout, the dot trend, and maybe the divergence reversal. I know people are a bit more wary about the divergence reversal because it is our only counter trend trade, but I think they're great trades. And they aren't super common, so we do have the divergence reversal has the most amount of rules, so we do take a bit more care in regards to our counter trend trades. All right, so let's get a couple of questions. Confi asks, do you have a filter that will tell what market to trade, or do you have to sort through all markets in the morning prior to market open? We look at 5 trades or 5 markets: the CL, TF, EMD, NQ, and YM. Those are the only ones we really look at. So of course you're more than welcome to check out other markets. There's really not any way to know ahead of time which market's going to be the best for the day. I think if someone knew that, we'd be in a different business. But some tips to help you if you're struggling or trying to determine which markets to trade. A good tactic is to watch a couple markets in the morning and go with the one that produces the first qualified winning trade. That's a very good strategy for beginners. Ideally, I would like to watch multiple markets through the day. I think a person can scan 2 markets pretty easily, as there's not always action going on in both markets at the same time. And if you get into a trade in one market, just stick with that trade until it finishes, until you get more comfortable managing multiple trades. So really no surefire way to tell what the best one is going to be for the day. But typically, over time, we've seen all these markets perform really well, even if they have kind of lackluster days once in a while. So, some of our members also like gold, the GC, or soybeans, I hear, is another popular one. So there are a lot of markets out there. You may like some ones we don't look at better. You may just want to load it up on a Pro9 chart, check it out, see how it moves, see if it presents enough trading opportunities for it to make sense for you to trade it, as some markets just don't move that often. There's not a lot of volume. Joe D, spotting them trades, says the last YM momentum was profitable and stopped, and now setting up another momentum. Let's take a look at our YM. So, yep, this one did hit our profit target. Got stopped out. We'd be looking at another momentum entry. And also a possible divergence. It is close to closing time. So we stopped trading the markets a half hour before their official close. So we would stop trading the CL. I was confusing your notification. So this is the YM. So no, we do have quite a bit of time. And another qualified momentum entry. And Joe mentions a single T near closing hour. That's the one I was getting confused with. All right, Jennifer, have a great day. Thanks for stopping in while you could. We'll get these recordings up on the website. Let's take a look at our CL again. Get current. Yep, this was a qualified single T, but as Joe mentions, it is very close to closing time. We would be out of this at 2. So, and when it comes down to the end of the day, that's really up to our discretion. You can do a few things. For purposes of the debrief, we just flatten at whatever price it is at 2 o'clock, and we'll calculate it that way. If you're in this trade, you may want to wait and see if you hit profit target. Really up to you. We can't really make recommendations one way or the other. but just a few options for you. Let's take a look at our good friend, the TF. Haven't checked this out today. Did have a qualified momentum right off the bat. Was a little far enough past the 200 that I would feel comfortable entering into that trade. I know some members will ask if we trade right at the opening bell or if there's a rule for waiting a certain amount of time after the opening bell. We don't have one. I will attempt to enter trades right at the opening bell. If you like to wait, you're more than welcome to. Coffee mentions, what time zone am I referring to? These are all in Eastern time. So we're just kind of going back and reviewing some of the trade setups bar by bar to give us a way to look in depth at these trade setups. So this momentum would have qualified and hit profit target. If you guys do want to cover the money management strategy more in depth, please do let me know. We can go over it again. Excuse me there, I had to take a quick sip of water. We are down to the last half hour of the class today, so if there's any pressing questions you guys really want answered or something we haven't covered yet, feel free to holler at me and we'll get to those. So here we see a pretty good run that would have triggered right after opening bell. So if we were hesitant about entering these trades right at opening bell, we could have missed this. And it is a pretty good run. Wow. So, and this is another great example of when widening to the DPI makes a lot of sense. And I just think it makes a lot of sense in general. But as we can see, there are two wicks here that would have stopped us out. And we would have avoided those if we're trailing at the DPI price rather than the high of the previous bar. Now in this case, if we were trailing at the high of the previous bar, we can get in on a momentum again here, trail at the high of the previous bar, getting stopped out here, and hop back in on another momentum trade. So, and this one would have hit profit target, but I'm always a bit wary after a run's gone on for quite a while of a wick popping up right before a turn bar, as that is going to happen. And Joe D asks a great question. He asks, if you miss this first momentum entry, could we enter this as a breakout? Almost, but not quite, and we'll go over why. So our breakout trade, pretty straightforward. We're looking for the price to run into the current high or low. So say I wasn't watching the TF at market open. I had the chart up, but I missed this momentum entry. And then when I look at the TF, it's already a couple bars. I'm not going to retrace back to my entry price. But I do see I'm coming up on the low of the day. So I may want to start watching out for a breakout. And that's basically rule one. We're looking for the price to hit the daily high or low. Next, we're looking for our neutral zone to be outside, or I'm sorry, our Pro9 direction histogram to be outside of its neutral zone. At this point, it's not. The neutral zone are these gold shaded areas on each of our histograms. So this is our direction. At this point, it's obviously not. It looks like we have 2, maybe 3 bars space before we run into the low of the day, so it may get there. Not sure yet, but we can watch it. Uh, if you see anything that looks like a trade may set up, and the entry isn't going to be for a couple bars, it's worth watching, see how it develops. So here we're getting to the point, we're really close. Let's check. So my current low is 1367.2, and my DPI that will create my next bar is 1367. So if this direction does not get outside of its neutral zone on the next bar, I will not be able to enter this as a breakout, because our entry price is going to be, will always be one tick above the high of the day or one tick below the low of the day, depending which direction we're going. And like our other trades, you can attempt a retracement if it's qualified. So I know by the close of bar 7, this direction histogram has to get outside of the neutral zone. In this case, it didn't quite get there, so I can't enter this as a breakout. And something I would like to point out as well is our rule 4, which is very important, and I find can sometimes cause a bit of confusion with new traders. It says the trade can be taken up to a maximum of 10 bars from the most recent white bar, meaning no later than bar 10. And that's what these numbers here keep track of for you. So we know that the 7th bar was the one to break through the low of the day. Now it says up to bar, no later than bar 10. Does that mean I can enter now on bar 8? No, because our entry price is one tick below the low of the day. It's not the DPI of bar 8 or the DPI of the bar that breaks through the low. It's a very specific entry price that's in the rules. And I do want to clarify that that is part of the rules as well. So it's not arbitrary. It is considered a rule itself. So, and here the price isn't breaking out. It's continuing the initial breakout, but we're looking to enter at that price that breaks out of the low, not as these bars continue to plot. They're really creating the new low as they continue to trend down. So it's not the same as a breakout. And a very important distinction, because we don't want anyone to get in the habit of making late entries. Just as our other trades where we're looking as for a continuation, we can either enter on the turn bar or the first color bar if it qualifies on one of those two bars. We don't want to see the trade qualify and enter on the DPI that creates the third color bar or any bar later than that. Now, if it's a momentum that happens in the middle of the run, that's fine. But we do have very specific entry points or entry prices that should be followed, because otherwise it's likely not a qualified trade. So that's the reason that breakout doesn't qualify. We have some other trades. I'm trying to find, as we went over a couple long runs, I'm trying to find an example of a divergence reversal. Here we have a nice dot trend, nice qualified dot trend short. So 2 in one day on different markets, but and you'll often see that for some reason the trades will, or dot trends will usually pop up on the same day in a couple markets, and then you won't see them again for a couple weeks. But again, so this time we'd be looking at a dot trend short. We are looking for a red dot, which will show up somewhere before this turn bar. So you'll have a couple bars warning that maybe I should be looking out for a dot trend. Once we see that, then we're looking for our EMAs to be in the correct order. And in this case, we're only looking for the 20, 50, and 200 to be in the correct order. And as long as those remain in order, that rule will be qualified. It doesn't matter where the 10 is. If the 10 stays in the correct order, that's fine. That's extremely rare, so you often won't see that. The 10 will dip up and usually bounce off the 20 or the 50. But it's just important that our 20, 50, and 200 EMAs are in the correct order. The blue line needs to be on the correct side of the histogram for a short trade. So it needs to be below this purple line, which it isn't yet, but it can also qualify on the first color bar. After our first color bar plots, we see that it does cross to the correct side. So we could go for a retracement to our original turn bar entry price or the first color bar, because we would have to wait for this to close to confirm that the blue line went to the correct side. So at this point, I'm not very comfortable that the blue line is going to cross if a color bar plots. It may, as we did see, but I'm not sure. And I like to follow the rule. If I'm not sure, I'm going to wait for confirmation. I feel it's better to do that and possibly not get on a retracement entry, even though we can often retrace to the first color bar entry price at least, than to enter ahead of time and put ourselves in an unqualified trade situation, as we saw with one of the first trades we looked at in the NQ, where the blue line was very close but didn't quite get there. And so we'd enter on a retracement and follow the same money management strategy as before. And it looks like we would hit profit target and the runner would get stopped out by this wick. BC asked a question. So clarification, a breakout trade after an initial breakout of the high or low does not qualify unless there is a momentum arrow. Well, that would be just be a momentum trade. I just wanted to make the distinction that the breakout only happens on this bar, the bar that breaks through the low of the day. After that, we're not going to be able to enter into a breakout because it's no longer really breaking through the low of the day. We're just creating a new low of the day as the price continues to move until there is the next established low. So that's what, when it breaks through an established low is what we're looking for. So any momentum arrow we get past this is fine to enter because our direction histogram is outside of the neutral zone. That's fine to enter as long as it qualifies as a momentum. So it's not going to qualify as a breakout after that point. So that's just the distinction I wanted to make. Not quite a divergence. Let's see. And here again is another example of that, those three waves we were talking about earlier. So we have these two that are really close. It's just a short run and then a small continuation. And then we have a nice long run. And then this one does go, but it's a bit obviously much shorter than this one. And then we've kind of run out of steam. And now we're heading back up and a little indecision in the market. Maybe trying to go back up, not quite getting there. Really would like to see, here we go. All right. A qualified divergence reversal here. Matthew F. asked about the breakout. It needs to break through the low and high and not make a new low high. Yeah, um, I notice it can be a bit confusing, but I like to look at it as this here, this level right here at 1345. This is the established low. That's what I like to say, established low. It just makes it more precise, I feel. So we'd be looking for a breakout after the price breaks through this established low. And our entry is always going to be one tick below this established low. It's not going to be one tick below this new low that was created or one tick below this low, because if we're looking here, we're trying to get into, we're preparing ourselves for a breakout. We missed this entry here just for argument's sake. So now we see that the price, we're heading toward the low, and we know that the next couple bars are going to break through it. One of them is. And our entry price is very specific in the rules. One tick above or one tick below the low of the day. And so once we get to that point, this bar didn't even break through, so it'll be the next bar. But our entry price would still be one tick below the low of the day. So, and the way I like to think of it is you're really only going to break out or break through the low one time. And I don't mean through the whole day, but one established low. You're only going to break through that one time, and then you're going to have a new low eventually. So, and that's why I like to look at this as these are creating the new low as they continue, because we don't know what the new established low is until the price kind of reverses a bit. So it's kind of a technicality, semantic type thing, but I feel it's just, I think the easiest way is just to think of it as the breakout occurring once. And if you just remember that the entry price is going to be one tick below the low of the day, when we're waiting for that breakout, that's the only entry price we're looking for on that particular breakout. So if it breaks out, then the price moves back up, we'll have established a new low, and then we'd be looking to get in at one tick below this new low, if we get to that point. So I hope that clarifies for you. So it is more of a wording thing, I feel like, and how, you know, we talk about lows. Because of course, if you look at a different type of chart, you know, you'll see a new low established in a different way. So for these charts, I like to think in terms of these established lows, highs or lows. All right, let's take a look at our counter trend trade, our good friend, the divergence reversal. Now, you will notice this does have quite a few rules compared to the other ones, but I don't want it to intimidate anyone. It is actually pretty simple once you know what you're looking for. So first, in the case of a divergence reversal short, we'd be looking for our red dot. That's going to be the first clue that a divergence reversal may be on the horizon. And as I'm sure you guys have seen watching the charts, the dots will show up somewhere in the middle of a run and continue trailing these color bars until a turn bar plots, and it'll stick to the turn bar, or if its qualifications aren't met, it will move on to the next time it is triggered. So that'll be our first clue. The second thing I like to look at to really let me know if I should be looking any closer at a divergence reversal is our super trend. Since the super trend needs to be way outside of the neutral zone, it needs to be outside of its extreme zone, which is plus 60. So you see that it is pretty bloated, and you can think of the super trend as a giant rubber band or slingshot made of money. And when you stretch a slingshot or rubber band to its limit, it's going to snap back with a lot of force. So that's two of our rules. We have our red dot, and in this case, we do have our super trend outside of its neutral zone. And next, we're going to look at rules 1 and 5. And these are kind of two sides of the same coin. And it basically says we're looking for the price bars and the blue line to be moving in the opposite direction for at least 5 bars from the most recent turn bar, which would be this one, and no more than 10 bars. So the easiest way, I think, to look at this rule, and since we're also looking for our blue line to be on the correct side of the histogram, you'll often see these numbers start counting sequentially, and this does let you know that the blue line is moving in the opposite direction of the current trend. So it'll start counting sequentially when that's the case, and you'll often see the blue line cut through on the turn bar. So when this cuts through, this number needs to be between 5 and 10. Any number between there is acceptable. The sweet spot is 7 to 8, but any number between 5 and 10 does qualify this trade. And so that wraps up rules 1, 4, and 5 in one, really. So when we see this counting sequentially, and we see our blue line cross to the correct side of the histogram, and this number between 5 and 10, we know that those 3 rules are qualified. So we have our first 5 rules qualified, and next we have our rule 6, which states that we're going to wait for 2 color bars to plot after this point to make sure this doesn't turn into a continuation. Because what can happen is, even though we have all the signs for a divergence reversal, the trend could be so strong that it will plot a red color bar and then plot another turn bar and turn into a continuation. So we want to exercise a bit more caution and make sure that we're going to actually see a price reversal before we commit to it. And in this case, so we did see our 2 color bars plot, and now we're here. So once we have our 2 color bars plot, we're going to attempt a retracement entry to our initial turn bar entry price, which in this case was 1356.2. And we can see by these wicks and tails on this bar that it did go far enough to let us get in on a retracement. And what I like about the divergence reversal is that often before this bar even finishes closing, we'll hit our profit target. Since we're looking for an 8-tick profit target, which would be at the close of bar 3, so we could have hit our retracement entry and then come back down and hit our profit target before this bar even closes. Now our runner may get stopped out, but we still did grab 16 total ticks for that trade. So one of the things I do like about the divergence reversal and the way we enter those trades. And of course, with any retracement entry, there is of course the chance that we will not enter or get our retracement, and that's going to happen, and there's just nothing we can do about that. Just as there's going to be trades that happen too quick for us to qualify and enter in. We may get an option for a retracement after that, but you never really know. Joe D mentions a couple trades we can look at. I may have missed them, as I really wanted to cover that. Did say a continuation setting up. Yeah, and in this case, I would like to, so we didn't get our blue line here. I would like to wait for this color bar to confirm. Since our direction histogram is extremely bloated, we can see it's very high up there. It's almost to its extreme zone, which it rarely gets to. So we may run the risk of the blue line not quite getting there. So I would wait for this color bar to plot just to confirm that that rule is qualified. Because again, if we're not sure, we want to wait and make sure the trade is fully qualified. Of course, the ideal situation is to see these ahead of time, but that's not always going to be the case. All right, everyone, we are down to the end of the line, end of the road. We are 5 minutes from the end of the class. I would like to thank everyone for joining me. I hope you all learned something more that you didn't know before you came in. If there's anything you would like to cover tomorrow, either jot it down, make a note to yourself, and bring the question to class tomorrow. If there's something we didn't get to today, just remind me once we get in class, and then we'll cover that in more detail. Tomorrow we'll review some more trades. We'll walk through one of the markets like we did, as I feel that's a good way to give an example of how to anticipate and keeping a running tally of what rules are qualified as the market continues to move. That way we don't have to, every turn bar we see, we don't have to run through all the rules, as that takes more time. And it's something that gets easier with practice once you memorize the rules. And it is just ultimately pattern recognition. So, and the best way to do that is just watch a lot of charts. And then if you have to have the rules up, double check them. We do have this handy Honey View. It's called. It's a free program. This will also be under the resources, under essential tips. Now, if we come down here to the hover rules, you'll just download this program, Honey View. It's a free program we found. And then links of our rules. And follow these instructions to set up the settings how we have them, so you can have your handy rules, move them around all over your screen however you like. Very helpful, especially when first starting out, so you don't have to jump back to the members area to confer with the rules. Can make it a bit easier. You can just stick them in the corner of your chart, because we don't really need to know all this that already happened. We're really concerned with what's happening on this side of the chart. And really, you only need this much information to spot a trade. So another helpful tool, and it's just practice, screen time. Nothing wrong with just jumping right in with sim trading. The best way to learn is by making mistakes, and you don't want to make mistakes with real money right away. You want to make sure you have a good understanding of the rules, at least for the single T and continuation when first starting out. Those are what we call our bread and butter trades. So aside from the momentum, you'll probably see those two the most often, and they are responsible for a good portion of the profits we see with Pro9Trader. All right, everyone, we are done for the day. Again, thank you for joining me. I hope the rest of your day goes well. If anything pops up later in the day, feel free to send an email to support@academydaytrading.com, and we'll get you squared away as soon as possible. Until tomorrow, I hope the rest of your day goes well, the rest of your trading goes well. May the EMAs always be at your back, and happy trading.